So yes, we had another 75 basis points today, taking it all the way up to 3.25%. Today we're going through how Toronto real estate prices are crashing on average $1,000 a day. Think about that for a second. That is a lot of money to be losing every single day. And if you're a buyer on the sidelines, you're effectively being paid $1,000 a day to sit there and wait. So what on earth is going on with this? We're going to get right into it. Please make sure to hit that like button. It greatly helps the videos get out here on the algorithm, and subscribe if you're interested in stuff like this. We're constantly diving into stuff like this. So first of all, actually, before I bring up this article, I think I should bring up the actual prices across the country so we can just go through that, because I know people will be interested to see that. So I'm sorry that I don't have an up-to-date one going to August. You know, unfortunately, us on the outside of the real estate mafia, we have to deal with scraps that we find on the floor in order to form our statistics, because, you know, they keep their cards very tight to their chest in the real estate mafia. So anyway, Canada average house price down 18.2%. I'm noticing this says seasonally adjusted average home prices, which are not the best by any means, but we'll go with these anyway. And you have to remember that these are nominal price decreases, so you can tack on another 8 to 20% depending on where you think inflation really is. So Canada as a whole, the prices have fell more than 20% in real terms. Kitchener, Waterloo, 20%. Hamilton, Burlington, 15.6%. Greater Toronto area down 15.1%. Calgary down 8.1%. Remember, everybody was saying Calgary's not going to go down in price. Well, that's funny. It's right behind Toronto pretty much. And if you look at where Calgary went up to during this massive boom, it had nowhere near the rise. So I think people playing in Calgary are playing with fire. But I have to remember, from the perspective of a bubble, people are just going to go to the riskiest markets and do the stupidest things in terms of these bubbles. So people really are playing with fire, because when you talk about negative equity and the probability of you losing the home and going into foreclosure, as we went through with that article from 2008 in the US, which was talking about everything that happened, and if you haven't seen that video, I'll link it at the end here. So just stay to the end and you'll see it come up, or I'll link it in the pinned comment. But anyways, that video, we were discussing what was going on in 2008. The probability of you being foreclosed on if you're in negative equity, that was the main driver. That was the main thing that they saw when they were analyzing all that data, and there was just tons of data that they analyzed, was that the main thing that impacted people was negative equity. Now you have that with a job loss and you're totally screwed. You are absolutely screwed. And guess what? If you're a landlord, you're equally as screwed, because if your renter loses their job, you can be in a bind trying to get them out or whatever. So all I'm saying on that front is people are playing with fire there, because most people who bought in 2021 are going to be in negative equity over the next couple of weeks, just like in Toronto. So there's no safety net there in Calgary. It's just a case of people have lost their mind completely, basically. So Ottawa, actually, I don't need to do that. So Ottawa is down 7.3%. Greater Vancouver is down 6.4%, but sales have absolutely collapsed in the Greater Vancouver area. So that's interesting to note. And Edmonton down 5.9%, and the prices barely even went to new highs. They didn't even get to new highs in Edmonton. Prices down 5.9%. So yeah, anyways, people are fixated on Calgary. But you know what? Just because something's cheap does not make it valuable. And that's what I was trying to say today. People who try and catch a falling knife are going to be in real big trouble in this crisis, because the fact is that the people who buy later and later on trying to buy the dip, they are more likely to lose their home than people that bought last year, if you can believe it. So that's really the crux of the matter. So I just think people bargain hunting in this area are just really, really stupid, in my opinion. And I don't say that to be condescending. I just say that, you know, it's the reality. Like, anybody can see it. I'm just stating the obvious here. So don't have a cow, man, as Bart Simpson would say. Anyways, Winnipeg down 5%, Montreal down 2.9%, and Quebec down just 0.1%. So Quebec not really down that much at all. But if you look at the average price compared to a lot of different places, it's actually down. It would have been good if they gave us the markets that were up, because I'm guessing some markets were up, maybe Halifax and Nova Scotia, something like that. But they didn't. So anyway, thank you, T.S. Sarkozy. I hope I'm saying your name right, for the super chat. Thank you so much for supporting the channel, my man. Thank you. Or woman. Okay. All right. So anyways, let's go share. I'm just going with the probabilities because 80% of people that watch this channel are men. All right. So Toronto real estate prices fell on average $1,000 a day, down over 15% from the peak. That is crazy. Greater Toronto real estate prices continue to fall at an alarming rate. Yeah, no kidding. Toronto Regional Real Estate Board reported composite home prices fell further in August. A typical home has seen prices fall an average of $1,000 a day, reversing nearly a year's worth of gains. Negative growth is expected within weeks. So that's really interesting. First pause there is because if there's negative growth that is expected now in the next couple of weeks, let's say that happens and follows through, that means loads of people that bought last year are going into negative equity. And we're just going to take a second here and talk about trigger rates regarding the Bank of Canada's interest rate hike that just happened. So today they just raised 75 basis points. If you haven't seen the funny short that I did with Trudeau and what's happened since, you've got to watch it, because it's just, well, I was laughing at it, which probably means it's terrible. But anyways, so yeah, trigger rates. Basically, trigger rates, a lot of them are going to get triggered this month because people's mortgage payment, the amount they're paying in interest, is going to overtake what they were paying. Like, they're not going to be paying anything towards the principal anymore, and then effectively their rate gets reset, or they have to deposit margin collateral to do whatever. So the thing is, which is really, really interesting, is the prime, well, not the prime rate, but the variable rate that people are likely going to be reset to is between 5.3% and 5.5% now. Think about that for a second, because if somebody got in with a teaser rate of 0.99%, yes, the variable rate last year, you could have got 0.99%, are going to see their mortgage payment absolutely go up by 200-300%. Like, it's going to be a massive rise if they reset to these higher rates. So it's going to be absolutely devastating for these people. It's not going to be immediately evident either. People who are expecting suddenly just thousands of foreclosures to hit the market, hate to disappoint you, but it's not going to happen. It will take time for that to come out the system. You're going to see this appear in other places. A reduction in consumer spending will happen. Credit card debt and other forms of riskier debt will start to rise. The banks get into trouble in these scenarios because none of this is getting paid back. And that's really the crux of the matter. And all at a time when the bank is doing quantitative tightening, when the Bank of Canada, should I say, is doing quantitative tightening. So this puts the banks in a incredibly precarious place. Do I think they're going to go bust? No. Although I did have a dream the other night that RBC went bust. I'm just putting that out there in case it ever happens. I don't think it will happen. It's really, really strange. But anyway, things I dream about on my own time. But yeah, you've really got to think about this, because this is going to have a drastic impact. And couple that with rising unemployment. Canada is already losing jobs. It'll be interesting to see. I think it's tomorrow the jobs report comes out. So it'll be interesting to see how that comes out. But really, we have to get like 6-8 months of jobs reports to really know where the trend is going. And if the trend is going up in terms of unemployment, which it is most probable to do so, then what's that going to mean to all these people who took out variable rate loans? That's the real thing. So you really got to think about that, because I think it's incredibly interesting when you really think about it, because you got all these things that are swirling around, which is sort of creating this toxic kind of environment, this toxic soup. So you really got to be aware and conscious. And, the thing is, looking at this data and everything that's happening, it just doesn't seem like everything is going to go to the moon again. Like, that is just so, it's just not likely at this point. So, to the people who are sitting on the sidelines, if you are sat on the sidelines, you're winning at this point. But there is going to be a stage where prices likely increase a little bit, or there's a little uptick in activity. And what do you think the real estate industry is going to do with that? They're going to run with that. You're going to see it all over the press, and they're going to try and start up the fires again, which will probably have little effect when it really comes down to it. So anyways, going off topic there. So Greater Toronto real estate prices fell $33,000 last month. Greater Toronto real estate prices are still falling and doing so at a brisk pace. The composite benchmark price, which represents a typical home across the region, hit 1.125 million in August. It's down 2.8%, minus 33,000 from July, remaining 8.9% plus 91,000 higher than last year. But when you factor in inflation, you're pretty much break even. So remember that. And prices in real terms are really what matters when it comes to currencies and everything that is happening with the money supply. You need to really be thinking in terms of real prices, especially with the ridiculous government that Canada has in charge. So mixed messages on what it means, but it could be good news for buyers. Okay, so it basically says here, and then there's a chart. So I like this chart, and it shows you how large this bubble really is. So I really like it. And, a lot of people are going to say, you're absolutely insane when I say this. But around the trend, when I checked on a chart for, basically Hyman Minsky, check all that out, and his theories when it comes to prices reverting to the trend and usually below it. I mean, this is something that has been well documented and happens when bubbles burst. They usually go right to the trend and then below it. So where would the trend actually be for Toronto home prices? Well, I'm going to say it, but it's going to shock a lot of people. The reality is, the chart I was looking at, which really was a historical chart, and I coupled it with a chart like this, which goes to present day, was back in 2012. And obviously there's been a lot of inflation since then. And it had the price at around $450,000 was where the trend is. Now, you could say with inflation, it's going to be around 550, which only takes you back to 2014 prices. So, that's not that really long ago. It's 8 years ago, and you're still not getting past to the pre-bubble prices, which were before 2008. So you really have to think, even though a lot of people are going to say that is never going to happen, there's no way in hell that's going to happen, you have to really think that's just going back to 2014 prices. You're still up if you bought in 2008 with that. So, and the thing is, that was $2012. So now it's probably, when it was 450 at the trend and I plotted it, it's likely to be 550, but it's likely to go below the trend anyway. But around 550 is where your trend is for prices. So that's when the average price of a home gets to $550,000 in Toronto, which seems inconceivable to happen. It just doesn't seem like it could happen, but it very well could happen. Because what people don't understand is the amount of speculation that has gone into markets like Toronto and Vancouver that isn't backed up by anything fundamental. It's not backed up by people are making more and producing more. It's backed up by the reinforcing cycle of bubbles, which has led Canada to be more and more dependent on real estate, especially the Toronto area is incredibly dependent on residential investment, which is everything, like renovations and everything along that lines that goes into homes, like having your basement done, whatever it is. All that counts as residential investment. And there are so many businesses around that, so many home builders, developers that have built up a business around that. And now they are really starting to struggle. And that really, it takes time to become obvious. We've already had that home builder in London that's gone bankrupt. Well, not gone bankrupt, but basically gone into receivership. So basically gone bankrupt. And I'm sure they're not going to be the last one. And that's why we covered it here on the channel about a month ago or whenever that story broke. So the thing is, prices could correct. They're never probably going to go to 2008 levels, and how long that could really take place over is anybody's guess. Nobody could say it's going to be 1 year, it could be 2 years, it could be 5 years. Who knows before you draw down that amount of prices. How much you draw down essentially when it comes to that. So it's going to be interesting going forward to see what happens. But yeah, it looks like a peak, and it's certainly bigger than the peak in 2017, which is the only peak since then. So this really looks like a top is in, but I guess we're really going to see. But when you look at that historical trend line, and when you look at what's supported by wages, you're really looking at around $500,000 average price for a home. So think about if it just got down to $700,000, what that would do to people. So many people would be in negative equity, and it just causes a cascading waterfall of foreclosures, power of sales, everything like that. And that basically just continues to create a disaster, because then you have all the ramifications of people becoming unemployed because of that. And it's just a complete nightmare for people. People have been living on fumes in Canada for way, way too long. And unfortunately, at some stage, you got to pay the piper, and it's going to come out. People who think this is going to continue forever, good luck. That's all I'll say. So home prices fell on average of $1,000 per day. Man, they keep repeating that. Feels like I'm on repeat. Prices are falling fast, but they're still up considerably. August price decline saw the average price of a typical home fall over $1,000 per day on average. At the same time, prices are up $91,000 from last year and $279,000 higher than March 2020. The vast majority of homeowners in Greater Toronto are still up significantly, which is true. It is very, very true. And these things don't happen instantaneously, but definitely the deceleration and the decrease in prices has been much more rapid, which is always the case with bubbles bursting like this. So really, it's just going to have massive effects. Annual home price growth is back to October 2021 levels. So basically, anybody who bought after October 2021 is starting to head into the red, even possibly before that because of real estate fees and everything like that. Annual growth is decelerating and expected to go negative in the coming weeks. At 8.9% in August, this is still higher than home prices typically grow. However, it's the lowest rate since June 2020, which was in the middle of the cerveza sickness. And it was funnily enough when that short video I just created when Justin Trudeau came out with that statement and said, hey, you know, interest rates are low, we're going to spend. Look what situation Canada is really in now because of all the government spending. And that's really why a lot of people are going to be looking for the door. And that's why, you know, I'm trying to help people out. I'm going to be leaving myself. That's why on Patreon, I just posted a video on how to get remote jobs, remote work. I want to help as many people to do the same as possible. So the thing is, this country is in such a bad place right now because of the amount of debt the government is holding. They have to pay to service that debt. So it's like that reporter says, funnily enough, in that short, it's either going to be paid for by tax increases or cutting services. So which one is it going to be? Well, we know it's not going to be cutting public services because this is a liberal government. So it's going to be tax increases. Bingo. And there's already been tax increases. You've seen the carbon tax go up, and we're probably going to see taxes go up even more. So it's just going to be interesting going forward. And then it's got this chart. Greg, thank you so much for the super chat, buddy. Thanks for the videos, Luke. I hope mortgage rates keep going up. Your channel keeps me informed to what is going on. Thank you so much, Greg, for supporting the channel. I really, really appreciate that. I'm going to be actually upgrading this streaming software soon. So every little helps towards that. So thank you so much. And yeah, it's going to be interesting to see what happens. I mean, definitely mortgage rates. I don't know what's going to happen with the fixed rates. It's very hard to say because we're looking like we're getting to a stage where the market is sort of propped up, and I'm talking about the stock market. And it seems like it's drifting closer and closer to the moment where it starts to capitulate. And I don't think that yields are going to stay high when that happens. But it's really going to be inflation. If inflation comes back, which it most likely will, we'll see a period of disinflation, then inflation will come back, then those yields will absolutely explode again. Especially if central banks start to pivot on the CPI prints being so high, the CPI prints being so high, should I say. So it's going to be really interesting going forward to see what happens. But variable rates now are pretty much with this hike the same as 5-year fixed rate. So it's a no-brainer in getting a 5-year fixed rate. But still, buying right now is incredibly dangerous. And I'm going to be putting a video together on that because I feel like people need to get their head checked out about this, because really you have to be extremely cautious in the environment we're in. We're heading into a recession, likely. We all know that's likely to happen. A lot of people are going to lose their jobs. Don't subscribe to the hope theory of thinking that everybody is going to be safe and everything's going to be rose. It's not everybody is going to be safe. It's I'm going to be safe. I'm going to be okay. My job's fairly secure. That is just not a good mindset to get into. That's the normalcy bias. That's the normalcy bias at work. And 70%, studies have shown that 70% of people suffer with the normalcy bias. And it's no wonder that people lose homes, people lose everything in these sort of events, because you've got 70% of the population subscribing to this. They're going to be ill prepared for when this sort of crisis hits. So, and all I'm saying is when these bubbles burst, the worst time to buy is trying to buy the dip down. You know, 90% of people wouldn't wait until it looks like some sort of bottom is in, in unemployment as well. And then, you know, prices start to tick upwards again. That's maybe a better sign to go out there and buy, but not right now in this situation. In my opinion, it's just like you're trying to catch that falling knife. and it can just be a disaster. You know, Scott is coming back on Monday, and you know, his story is fantastic. He has a personal story about this, which I just think I keep bringing it up because he talks about how he learned from everything that happened, and he was lucky in his experience. He managed to get a short sale done and everything like that, and he's explained that in prior streams we've done. But when you really think about what happened to him, he essentially bought, he thought he was getting a good discount. Prices had gone down 30-40%. Now think of that. At the time, this was literally unheard of. It's like now in Canada, where it's literally unheard of, price declining by that much. He bought, then the unemployment started, and then guess what? He couldn't no longer have that house anymore because of job losses. And then basically, guess what? He had to short sale it, like a ton of people, and a ton of people went into foreclosure because unemployment always lags behind these hikes. So the tightening process you're seeing, it's going to take about 8 months is what experts say on macro podcasts and everything that I've listened to. They say 8 months it typically takes for these rate hikes to have an effect. So think about that. That means the March rate hike is only really starting to have an effect right now, and that was 25 points. So think about what it's going to be like in January, February. It's going to be a totally different environment to the one we're in. So, you know, and then that's really where we're at right now. So it's kind of crazy when you honestly think about it. So this chart shows you, this is the price appreciation, I'm guessing, for each year. So you can see how much it's gone up and gone down. And you can see how it's decelerating here and collapsing. But that has happened in 2009, and it's also happened in 2018. But the circumstances are completely different to both those times, in the sense we have a raging inflationary backdrop that is happening right now. And I don't subscribe to conspiracy theories or anything of the like. However, I will say this, it's going to be really interesting to see what happens to oil and gasoline prices post midterm elections. You know, there is a lot of OPEC countries screaming at the US, saying that the prices are not correct on the futures exchanging, and on the futures exchanges. There's a lot of discrepancies that are being argued about in pricing of oil. And essentially the CPI a lot is derived of energy. And also what's going to happen with natural gas this winter, with Europe essentially being cut off. I mean, Europe is essentially going into a depression here. I find it very hard for anybody that has an ounce of optimism in this sort of environment. I mean, there is nothing to cling to and say, this is going to be fantastic. And trust me, if there was, I would be actually saying about that this could happen. But there really isn't. You've got the backdrop of Europe heading into a depression. That will affect Canada. That will affect the United States as well. But you're going to see the also result of underinvestment in the oil and gas sector, which is going to come to fruition soon enough. But I don't think so until after the midterms, after you've got that capitulation phase out of the stock market. And personally, like, that's what I'm looking at. That's the primary stocks that are on my watch list are commodity-based stocks, and I posted them all the ones that are on my watch list on Patreon there. So it's really, really interesting. Let's see what else they're saying here, and then we'll wrap this up. I can't believe we're going 30 minutes. Jeez, I feel so bad. Home prices likely to see negative annual growth in October. When prices are averaging price drops of over $1,000 per day, the market is unlikely to see growth anytime soon. First, it would have to stabilize, typically occurring over several months as monthly price declines shrink. With the current momentum, prices should continue to fall in the coming weeks at a slower rate if the market improves. I think you will start to see a stabilization and possible increase in the price, month over month increase in the price I'm talking about, just because you've still got constrained inventories in a lot of places. And please let me know in the comments below, because I can't monitor every single market in the country. It's impossible. And I hope some of you guys are monitoring your markets. But let me know, is inventory still down year over year where you're at? Is inventory still quite low historically? It's still quite low here in Calgary. And that's pretty much obvious in a denial phase. And I wonder if it's the same situation in Toronto, because I've heard on FinTwit that it's a similar situation there. Inventory is still quite tight. So that does put a tiny amount of pressure there, which can actually mean when volumes start to drop off. Like Calgary, we're seeing a very, very fast deceleration in sales right now, but inventory is still quite tight. So if there was an uptick in sales, then yeah, you could have, it could be very, very interesting to see what happens. So, but the pure fact of the matter is this denial phase, it's going to last like 6-12 months maximum. And then basically, as soon as that unemployment hits, the denial phase is essentially over by that part. You're not going to see the effects immediately of that, but sellers can no longer hold off if they've lost their job. They have to sell. They have to push their house to market. And that would bring you around to the time frame of next spring, which is when everyone's typically listing their houses too. And we've gone over Pheonix a million times because that is a very frothy bubble market. It collapsed massively during 2008. And it was the same. You saw a stabilization actually of prices over the winter. And then during the spring, guess what? The prices absolutely collapsed. And that was when the new inventory hit. So just bear that in mind. Rome wasn't built in a day. It's not going to all happen like in 6 months. At least I don't think anyways, but we'll see. So unless a miracle or curse occurs to send prices higher within the next 2 months, October will see negative annual growth. The price of a home might also plunge 20 points below the peak, making it fit the technical definition of a crash. The former point means there won't be anything to soften the impact from a psychological angle. The latter point is likely to be a paradigm shift when the market can be referred to officially as in a crash. Breaking the speculative psychology is what's expected to pop the real estate bubble and restore the market. Especially when you think about most of the sales in these markets have been speculative sales and people that have just kind of been thrown into the mix there because their business or job relies partly on the speculation of that. So they've also got involved as well. And then you've also got people who are higher income earners who don't know really what's going on and just think that everyone is suddenly rich over the past 8 years. I mean, are you really saying that wage growth since Trudeau took over government has gone up like 200% to support the price growth in Toronto? Not going to happen. Are you really saying that foreign investors accounted for all that growth and money launderers? Sure, they were a contributing factor. They were not the main driver. The main driver was homegrown speculation. It always is and always will be in all these bubbles. So and Canada is becoming increasingly unwelcome to foreign buyers. And it's not so much what they do in terms of foreign buyer taxes that mean very little. It's more to the point of the psychology shift that people are going to have. I mean, think you're outside of Canada and the government is putting all these taxes in place. I would think the government doesn't want me to buy there. So I'm not going to invest my money there, at least if you had a brain between your ears. But, many investors don't. 90% lose money in the stock market. Those are just the stats really that are out there. So, you have to take a lot of things with a grain of salt because often I assume that people are clued up investors and making decisions from a logical and critical thinking standpoint, but they're just not. That's not the case. It might not sound great, but it's not all bad news. First-time home buyers are likely to emerge as the winner in the coming weeks. Many are now used to paying supersized monthly costs for shelter. The biggest hurdle many have is the down payment, which is frequently subsidized with loans from friends or family. Higher financing costs and lower prices mean fewer investors and more first-time home buyers, the opposite of what banks like RBC have been observing over the past few years. I don't agree with that statement. I think it's absolutely ridiculous, to be honest, to think that first-time buyers are going to benefit somehow from this at this moment in time. I mean, you've got the average price pushing $1 million, and you think, like, look at the default rates by age groups, and it is the first-time home buyer category that everybody is referring to in this that have the highest default rate, even higher than Gen Z. I'm talking about the Millenials, because Gen Z haven't had a chance to build up their debt. They're still living at home with mom and dad. So you really, I don't know. I just think that's kind of a ridiculous statement to think that first-time home buyers are benefiting at that at this point. Even if you've got, you know, mom and dad are giving you 100. Where are they getting 100 G's from? Are they, like, they're not just growing it in their backyard. They're probably taking it out of the money tree, which is their house. They're going to be less likely to do that moving forward. So I don't know. I think it's a bit silly to say that first-time home buyers are benefiting at this point. I really don't think they are. They're some of the most indebted people in Canada. They're some of the most pressured. They haven't been able to save because rents have been so ridiculously high. And, you know, rents will inevitably fall when unemployment starts to rise. And that's just really what we can learn from prior history has happened. You're also, when you start to see that inventory explode and really things sit for 6 months, a year, people are just going to try and rent it out. That'll happen pretty quickly. Then that drags down rent prices. Then that means people who bought high, they can't even rent for a profit. I mean, people who bought in 2021, they can't rent for a profit. They can't rent for a profit in Calgary. They can't rent for a profit in Toronto, Vancouver. You know, so if they need to sell, they need to sell. They can't rent it out and subsidize 30 to 50% of the rent payment with their own income. It's just not going to happen, especially with the real rate of inflation, not the CPI, as the government says, the real rate of inflation pushing 20%. So anyway, it's interesting, guys. You know, the Bank of Canada also said that they see further interest rate hikes. I take that with a grain of salt because we may see a black swan event in between now and their next policy meeting. But if we don't, we could very well see another 75 points taking us to 4%, which I just thought was insane. Now, I'm seriously consider looking at 1 year GICs over the next couple of weeks. I'm going to see where the rates go to. And yeah, figure it out from there. I think it's risky to wait for the next hike because that may not happen. The probabilities are decreasing of that happen, but it could happen. So that's really just what's happening. Anyway, guys, I thank you so much for watching. Thank you guys for all the super chats. If you want to support the channel further, I'm on Patreon. Link is in the description. I put a number of videos out there on Patreon for the Patreon members only. So if you're interested in that, check that out. Also, subscribe to the channel, like the video. That is totally free and it really helps get the videos out on the algorithm. Thank you so much for being here. I really enjoy doing these live streams and we'll see where the market goes over the next couple of months. And I'll see you in the next one, guys. Take care. Peace. Bye-bye.